Hey, everybody. Welcome to week 137, but who's counting? We are. Yes, indeed. And if you are in Charlotte, we see this wonderful thing called the sun again. Oh, man, it makes me happy. But it's a little cold out there. So stand in the sun. Oh, man. Well, we got a treat for you. We have two, not just one, but two attorneys on today. Yes, the famous Jack Santaniello is back on, and Ashley Tison as well. And I'm anxious for you guys to meet Ashley because I met him 7.5 years ago when I came back to Charlotte, and he was part of the early launch of the F3 Nation, which is so cool. And he is an expert in opportunity zones. So we're going to go deep and wide into opportunity zones. So have that stuff ready to rock and roll. Oh my gosh, Papa Joe is back. Enable the chat. I mean, okay. I should have known. I should have known. We got a little lax, actually, Joe. We just have... without having you on there, we kind of missed you. And so we just got pretty lazy. So that's my fault. Adam is supposed to be on here, and I'm not sure where he's at. So he may have, I know we've got a lot of year-end planning stuff going on right now, but nonetheless, if he shows up, great. And if not, we got two attorneys and a bozo. So it should be good. All right. So you guys know the drill. Hit us up with Q&A, as Papa Joe has already done, to let us know that we need to get the chat moving. But we want this to be as interactive as possible. And if you don't know about opportunity zones at the beginning of this thing, you will afterwards. But we really do want to make this interactive. And this is, we'll tease in some other questions. And I do have some free legal questions that are kind of general.
Nothing like free legal advice, right?
Exactly. That's what we're here for, and it's funny because Jack offered it early on when we started these crazy things. Hey, would you like some legal advice? Somebody from a legal perspective. And it's probably a really good thing because we were probably getting in a lot of trouble.
So technically that's not legal advice, right? Jack didn't pay for it.
Right.
They can't rely on it.
That's right.
That's right.
That's right. There's a ongoing disclaimer that it's friendly advice.
Exactly.
And I just don't say that every time. Like, we were recently at an ABA meeting and they had some judges up there talking, and they're like, the words that are about to be spoken are not the words of the official California judiciary. They're opinions of the person. And I'm like, okay, you get it. So
this is not officially the stance of Schumacher, Loop, and Kendrick.
Yeah, there are lawyers in the room, evidently, with those kind of disclaimers going on.
I think that's a joke. Two lawyers and a dude with really cool glasses walk into a bar.
Although he called himself a bozo, I was wondering if he hadn't said two attorneys first.
I was not going there. He can self-deprecate all he wants.
Oh man, Jack, I know you have some current events, and hey, you know what? From what I hear, Arizona never got PBS. I mean, we got it in Kansas with the 3 stations plus PBS, which had Sesame Street and The Count on there. So we learned how to count 1, 2, 3. They're still doing that. I don't know what is going on in the state of Arizona, and it's always Maricopa County. Strange. Weird stuff going on. And
it's really strange that Maricopa County seems to be the nexus for not 1, but 2 significant elections.
Holy
is there
moly.
Coincidence here? I mean, good Lord.
Or incompetence. I think it's incompetence, but I don't know. So anyway, we will get ourselves in a lot of trouble if we go down that rabbit hole. So we'll avoid it. But Jack, I know you don't have the Washington, D.C. backdrop, which I'm kind of disappointed, just given, the events. But if you want to still take us down into some of the current events. Oh, Jack, you're
Fixed.
ready.
Fixed. I transported myself. I Star Trek myself into the White House briefing room. So here we go.
All right. So bring us up to speed.
All right. So I guess a side commentary is kind of along the lines of this counting thing. And I was talking to some of my colleagues who are a little bit older than me, and they said, you know, isn't it amazing that by 11 o'clock, 12 o'clock, on election night, we pretty much knew the election results. And now with all these computers and electronics and technology, we have to wait weeks and weeks and weeks to get it done. So I was like, yeah, I mean, not surprising that's just where we're at. I am going to share my screen and show you a chart that I found and zoomed in a little bit. Let's see, is it showing that screen? Okay, so this I found, and it goes back a couple decades to show the gap between Republicans and Democrats as far as, and then you see kind of the margin getting close. And so when you hear on the news that, you know, we're at the closest, and this is, they don't have the 2022 numbers in here yet, but you see kind of like as the gaps, the huge gaps, and then as the gap is narrowing, you see kind of a pattern of behavior, which is go wide, get narrow, go wide, get narrow. So who knows where we're going to go next. And then I do want to share some comments that
It's like
and
a
this is-
Rorschach.
yeah, it is. It's like, what do you see? Do you see a butterfly? So
Yes.
so here are the official comments from both sides. So McCarthy, first of all, that Republicans win back control of the House with a narrow majority is the headline from this morning, about an hour ago. And then McCarthy's comment is that he celebrated his party having officially flipped the House. Americans are ready for a new direction, and House Republicans are ready to deliver. And then in contrast, Nancy Pelosi released a statement saying, in the next Congress, House Democrats will continue to play a leading role in supporting President Biden's agenda with strong leverage over a scant Republican majority. So again, the as I've said, switching between Fox News and CNBC on your dial on XM 114 and 116, it just same story. It just depends on whose perspective you're hearing it from. So that's the kind of the latest and greatest. I won't go on any type of tirade. I'll reserve that for Adam if he ends up showing up, or he can double up next week. So,
well, and next week, oh, he is at a UNCC event, and evidently I was told about it, but I don't remember. So he gets a hall pass. So Adam won't be here for today, evidently.
thank goodness
so
Ashley's here, because that would have been a disaster if it's just the two of us.
Yeah,
so,
oh man, that would we would have definitely gone down some rabbit holes. I can guarantee you that. But we will not be here next week, because guess what? What is next Thursday?
It's crazy that it's already Thanksgiving.
It's Thanksgiving. Can you believe it? So anyway, week 138 will take a skip week, and so in 2 weeks. So anyway, yeah, so that's what's going on there. Well, so Ashley Tison is going to be talking about opportunity zones, and especially if capital gains are in your present or in your future, you ought to know about opportunity zones. It's not the silver bullet for everything, but it's an option that you guys ought to know about. So we'll go into that, but because I'm going to just make sure and see if any of our participants may be on here. Yeah, so I don't see them. So I'm going to go ahead and tee up this situation that we mentioned this week to this client, and they want some Jack theory. So not free legal advice, but some Jack theory. So here's the situation. They're making decisions on entity structure, and you guys know who you are out there. We do recommend that you actually talk to an attorney, and yes, it will cost you a couple of bucks or more, but it's worth making sure that it's done right. So here's the situation. One option is to simply have company B make an election, make an S corp election, but they're considering establishing an S corp holding company that's 100% owned by the same individual, owning both LLCs and having company A revoke its S election and become a disregarded entity. The question raised, is there any significant difference between or in the potential exposure to personal liability of the individual owner for the actions of the two companies under the above two scenarios? Oh, shoot. Hold on. I got to get this other one, because I was thinking it was all in the same email, but it evidently isn't. Okay. The fact pattern is this. Company A is a Tennessee LLC, elected to be taxed as an S corp. Fact B, company B is a North Carolina LLC, currently disregarded entity. All activity is in North Carolina and other southeastern states, but not in Tennessee. The owner actually lived in Tennessee for a little bit. They still have a mailing address there, but for all intents and purposes, things are being done here in Charlotte. Both LLCs are currently 100% owned by one individual, and to date, Company B has not filed anything. All activity reported through Company A's books may spin off divisions in the future. So any thoughts? Yeah, that's right. That's right, Papa Joe.
The following statements are not meant to be any particular legal advice, but are meant as friendly advice and should not be construed as illegal advice.
General
Okay.
suggestions.
All right. So the first answer, as Ashley knows, is it depends. And a lot of it depends. What we don't have in the fact pattern is, what is the tax basis? What are the assets of each entity? I mean, we were given some information, but generally speaking, recall a couple things: that in the scenarios you have pass-through entities. And so, there are certain tax consequences related to that. You have an S corp involved in the middle, but a part of the fact pattern is that the S corp election would be revoked, so you wouldn't have an issue with that. But the question is really surrounding, it seems like, personal liability. And for me, personal liability occurs in a handful of situations. The first is, and it's a very legal, technical term that I use, and it's called the bonehead things. If you do something bonehead, then you're going to be held responsible for it. Okay. So if you, steal, lie, those kind of things, then yes. If you breach your fiduciary duties as an officer or as a manager, et cetera, as a board of director member, those kind of things. If you are the, essentially responsible for the finances of the company, like the CFO, the IRS could hold you as being that responsible person, because they have to have somebody to go after, and there's some personal liability. So for example, with payroll tax, you don't pay for payroll tax. You can't say, well, the company didn't pay. I mean, someone usually, and it's not just only the owners sometimes. So it's those kind of things that come up that you need to think about. So, but otherwise what you're doing is you're creating a structure. Oh, and I'm sorry, the fourth is, or the next is voluntarily. So personal guarantees. Essentially, if you sign up for that, then you are going to be held personally liable for certain things. And you need to be careful. And this is part of the free legal advice is that with personal guarantees, you need to read the language, or have your lawyer read the language very carefully, because it could be more extensive than you think. Let me give you an example. In the franchise world, when a franchisee owner of the LLC signs a personal guarantee, it could include stuff beyond just the past due royalties, just beyond the past due advertising fund fees that were not paid. And so, you're basically guaranteeing those kind of things. Another thing that many people don't know is that, and again, in the franchise world, but just generally speaking, is that if you sign a personal, if you are married in the state of North Carolina, if you're married and you live in the state of North Carolina, and your deed is under North Carolina law that says husband and wife, okay, under most circumstances, if a creditor is just a creditor of the husband, they can put a lien on the house, but they can't foreclose upon it. As soon as that spouse signs that personal guarantee, you've just obliterated that protection. Now you have other protections outside of, in a bankruptcy context and that kind of thing, but you basically have just consented to put your house on as collateral, whereas you might not have otherwise if that other spouse didn't sign. So my suggestion is that, the person making the inquiry reach out to me, and I'm happy to chat about it further, but it really is a collaboration between your attorney and your accountant. So because there's tax and legal issues and implications, what is proposed, there's two options essentially are proposed. Either of them are fine and are doable, but you just have to understand the consequences. And also what is the plan for the future? As far as growth, there's mention in here about maybe selling off a division. Now, obviously, if you have a separate division with its own financials, et cetera, that's going to be easier to do rather than mixing and matching. But what does that mean for when you have the holding company, or let's say that the management is their employees of the holding company, which they probably shouldn't be, but you have a person, a financial person working 50% for company A and 50% for company B. Where are they getting paid from? Where are they paying their payroll taxes, et cetera? So they're, again, not trying to blow this up as an issue, but there's just a lot more things that need to be considered and analyzed on the legal side and on the tax side in order to be able to do this. But I do this all the time. I'm very good. I've become very good with PowerPoint to option A and option B and with little arrows. And actually now I know how to do the blending of the colors within the box and make it all pretty. I was
Did you want to be a designer?
I'm just a nerd. I mean, you guys know this. I've said this for 130 weeks. I'm a nerd. So anyway, all right. So enough of that, but I'm happy to have that discussion with the person who was asking the question.
Yeah, I'll definitely connect them to you, Jack, because they do need to go beyond the free Jack theory, non-legal advice on the 137th week of our Q&A webinars. But that's really helpful. And if nothing else, it underscores when you think that you are protected and you're just going solo, you might want to contact your attorney before you sign something.
Just saying.
Just saying.
Because after you sign it, it's a little too late.
Exactly.
Oh, and here's
by the other attorney.
Yes, and here's an unrelated issue, but we've had more problems with this, and Ashley, you've probably seen this as well, which is that you have an agreement, and maybe it comes to you electronically like a PDF, but then there's a reference to a website that says additional terms and conditions are located at this website, and then on that website is like a whole bunch of stuff that is not favorable to you as the customer or the debtor or whatever it may be. So I always, when I'm reviewing those for my corporate clients, like if they are the supplier or are being supplied, and then it's the other side's contract and it says, please refer to this, I always ask them, have you read this? And if you haven't, do you want me to read it? Because obviously the meter's running when I do that. And the answer should be yes, to either they read it or they want me to read it. But it's a lot of times it's on that, the backside of that contract, or it's in the boilerplate. And you're like, okay, sometimes it doesn't even show up as a hyperlink. Like it doesn't show as a blue underline. So those contracts do need to be read carefully for that particular issue. Not saying that it's enforceable in every instance, but it still needs to be reviewed, especially when there's a lot of acronyms and a lot of links and this and that.
Defined terms.
Yes.
One of the things that we used to do when that would happen. So when I was practicing law, because I'm a reformed attorney, so thankfully I don't have to practice law right now. I'm in the game. I actually got into the game. And sometimes that's good, sometimes that's bad. But when I was practicing, what we would do is we'd actually take a printout of those terms and conditions and then attach it to the back of the contract and then have our client initial them so that way they don't swap them out or change it or whatever and say, oh no, this is what it was back then, So that's a great point, Jack.
Yeah, that stuff is enough to make my head spin. It's like all the gobbledygook. No wonder Congress is filled with attorneys. Like, seriously, what is going on? So let's go ahead and talk a little bit about opportunity zones, Ashley. Give us an overview. Let's just start with, why would somebody want to consider talking about that? And then let's go into what the heck it is. All right.
I tell you what, let me start with what, and then
Okay,
that's going
that's
to
cool.
roll into the why, right?
Okay, cool.
But opportunity zones, and I think that if you haven't heard the word opportunity zone, you've been living in a cave, right? And so they've been, and they got a ton of press in 2018 when they first came out. And that's when I found out about them. I was at a CLE learning about how to mitigate generational wealth transfers and stuff like that. They were talking about updates to the Tax Cut and Jobs Act. It was after lunch. And so the guy up on stage was an E&Y guy, and he had this monotone voice. And he's like, bah, 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 bah. And he's like, and then in 3 pages, they created these things called opportunity zones, and you can invest capital gains and defer taxes and then ultimately eliminate them. And everybody else in the room is asleep. I mean, like literally they're like checking their emails or whatever. And so I kind of perked up and I ran the guy down in the hall afterwards. I was like, wait a second. I was like, dude, opportunity zones, what you just talked about, sounded like 1031 and private equity got married. And he's like, and they had the beautiful baby called opportunity zones. And I was like, dude, I'm in. And so I ran back inside and I started taking down domain names on my GoDaddy account. So many that my assistant ended up changing my password so I couldn't do that again. But we popped up a website and we had 150 inbound leads and like $75 million worth of cash looking for deals within 2 weeks. And I was like, okay, I think we're on to something. And I've been doing nothing but opportunity zones ever since. So what did that guy talk about in the 3 pages, right? So they were created by the Tax Cut and Jobs Act of 2017. And they effectively allowed each governor to designate up to 25% of their low income census tracts as opportunity zones. So if you want to find out where they are, you can go to a map right here. And this is an interactive map, and you can actually type in an address and it'll pop up, right? So I went to this page, I typed in Charlotte, North Carolina, and the most, I think, kind of ripe zones that are kind of the best zones in Charlotte right now are this 85 Crescent right there. And so, the North Carolina Department of Commerce designated these because they're like, okay, we want to encourage development in these areas because we'd like to see these areas turn. And then you got one down in Monroe, like a big one down here in Monroe, that's low income census. And then you got a bunch out the 85 corridor, like going towards Gaffney as well. And then there's a huge one down like in Kings Mountain or past, well, this is Kings Mountain right here, but then past, once you get across the border in Blacksburg, there's a big one right down there as well. And so what an opportunity zone is, right, is it's a place, it's a census tract, right, where if you invest money into it, you are able to get 3 benefits out of it. The first is that you're going to get deferral on your taxes, right? So any capital gain that you invest into a qualified opportunity fund within 180 days, you're going to get to defer those taxes until December 31st, 2026. And as Jack is sitting in the White House briefing room, hopefully we're going to have a White House briefing shortly about the pending legislation that's bicameral, bipartisan, that we think might get passed through on an extender bill. But if it doesn't, it'll probably be the first thing that gets teed up when the new Congress is seated on January 6th. It's an extension of the Opportunity Zone program, and it's going to extend it out 2 years, which will extend out your ability to be able to invest all the way to December 31st, 2028. And it'll also extend your deferral until December 31st, 2028. What that will also do is pick back up the second benefit, which is that if you're invested for a certain period of time before that deadline, right, you get a reduction in taxes when you go to pay them in either 2026 or 2028. So if the legislation goes through as drafted, it'll pick back up that 15% reduction. I have people all the time tell me, well, man, I thought that this program timed out. And what they were talking about is this time period, right, that expired in 2019 and 2021 that is now back on the table if you invest in 2023. So those are great benefits, but the really big one is this step up in basis to fair market value. And so after you've held your investment in a fund for 10 years, when you transact after 10 years on any asset that is owned by the qualified opportunity fund, whether that's a business or individual assets themselves, you get a step up in basis to fair market value. And that's really significant because it not only eliminates capital gains, but it also eliminates depreciation recapture. And I think that that's actually the fourth benefit, is depreciation recapture going away. And so, as you guys know, right, having been on this show, I'm sure that you've talked about cost seg studies and the benefit of bonus depreciation and how powerful that can be. But the tail on that dog is recapture when you sell. And in opportunity zones, that goes away. So it effectively allows you to defer taxes, make your money, right, make cash flow during the life of the deal that you can use depreciation to offset so you don't pay taxes on it, and then sell it on the back end and not pay any taxes. So I'm going to stop right there and see if we got any questions, Gary, or if you got any questions that you want to throw out there that I can answer, right, relative to just stuff that you, because I go fast in these because I've been doing nothing but for 4 years. And a lot of times people are like, whoa, slow down, dude.
Yeah. Talk about the difference between and what is available from an active versus a passive option in investing in these opportunity zones.
Yeah, so I think that as of last count, there's about 10,000 qualified opportunity funds that are out there. I know that we've set up almost 1,000 of them ourselves. And so there's all types of passive options where people are raising money. And so, there's Origin investments, there's Caliber funds, there's the guys at Urban Catalyst, right? And so there's people that are doing multifamily deals. There's people that are doing hotel deals. There's people that are doing mobile home park deals. I'm invested in a deal that's doing 5 hotels down in Puerto Rico. So the whole island of Puerto Rico, 98% of it is an opportunity zone. And so there's really, really good real estate that is designated an opportunity zone because it was a low income census tract back in 2010, right? And so they did not, when they put this through, they had to designate it with 2010 census data. And when the 2020 census data came in, they're like, it's going to be too much of a train wreck to try and figure out how to change them. And so we're just going to leave them set as of the 2010 data. And so as a result, right, so it's that, some of the ones in Charlotte, you got, the corner of Moorhead and Freedom Drive, right? That's an opportunity zone. And that real estate is gold right now, right? And so there's places like that all across the country where you can make a passive investment into a deal. So Grubb Properties has got, I think they've done 2 opportunity zone funds, right? They're a developer here in Charlotte. And then, so that's on the passive side. If you want to just put your money with a sponsor and have them do the projects. Then on the active side, and this is the really cool thing about opportunity zones, is that in reality, all you have to do is invest into a qualified opportunity fund, which is technically just an LLC taxed as a partnership. That's as easy as it can be. And so you set up your own LLC, you bring in a partner, right? Whether that's like an adult child or whomever you want. And then you put your money into that within 180 days. Now there's some special language that you need into organizing documents, but that's what we do, right? So we crush those things out all the time for people that want to do their own captive opportunity fund. And then they're able to either invest into real estate in these zones, or the really powerful thing about this incentive is that you can invest in operating businesses. And I think that that's where this is a huge differentiator from any other economic incentive, place-based economic tax incentive that the legislator has ever created, because it allows you to pull in startups. It allows you to pull in high growth companies and that kind of thing. And so it's really powerful as a result.
What are you seeing as far as interest levels in Charlotte, let's talk about in Charlotte in particular, between when it first started coming out and even through the rockiness of, recessionary fears. The last couple of years have been a little rough. I'd love to know, like, what are you seeing? What are the changes? Who are the kind of people that are drawn to this? Who,
Well, at
let's
first it was
start there.
Yeah, at first it was big private like family offices, right? Because they understand the power of tax-free compound interest, right? And they understand the power of being able to get direct investments with tax-free compound interest. And so they were all over it. I mean, from the outset, they were like, all right, we've got professionals who are giving us heads up about kind of current things happening. And so that was the lion's share of people that I was helping out in, May of 2018 when I first started this thing. Then slowly it morphed into folks that are regular investors that had some kind of capital gains, whether that was from the sale of real estate, from the sale of a business, from the sale of cryptocurrency, or from the sale of, any appreciated asset really, that were like, okay, I want to utilize this at the very least as a way to where I don't have to pay that tax bill coming up next year. And so, and that's the kind of the crucial differentiator between this and like a 1031 is with a 1031, number one, you got to put the money with a QI from the outset from the sale. Number two, you got to identify property in 45 days, and then you got to close in 180 days. The beautiful thing about this is that you just have to move the money into a qualified opportunity fund within 180 days, and it's fungible. It's any cash that matches up with the gain. It doesn't have to be the exact cash that came out of that transaction. And so as a result, we've been able to utilize it for people that have had failed 1031s. We've been able to utilize it for people that are like coming up on their tax, where they got to write the tax check and they're like, holy crap, I don't want to write that check. And so they come to us, we drop it in a fund for them. And now they've got almost 4 years to figure out what they want to do with it. And so that's the really powerful piece about it. And so it's, if anything, it just buys people time. And then it's funny is that, we've done that for people who are like, all right, I want to do this. I've heard about it. You've educated me about it. I feel pretty comfortable. Let's set up a fund. They drop their cash in, and then, they go about trying to find a deal themselves, and they can't find a deal. And then they come back and they're like, you know what? I want to look at other funds. And so they end up investing in somebody else's deal that they're managing it. So totally fine, right? Or I've had a couple of people that have come back and be like, you know what? I need to use this money somewhere else. I've done my due diligence on these other deals in the opportunity zone. I've decided that I've got a better opportunity outside of the zone. I don't want to do this anymore. Let's break it down. Let's dissolve it. Okay, no problem. So we distribute the money to them. That triggers what we call an inclusion event. And then they pay the taxes in that year. And there's no back taxes. There's no penalties. There's nothing else. And so, I mean, obviously you can't do that as a tax deferral strategy because that would be a tax shelter, right? That is not okay. But if you are legitimately looking for trying to do a deal in an opportunity zone and you can paper that up, it's absolutely okay, right? You just changed your mind. Stuff happens, right, within the economy. And so we've seen a fair amount of that. Now, it's funny because I thought that, as the economy kind of slowed down, right, because people aren't having a volume of capital gains that they were when the economy was roaring, that we'd see a serious trail off of, people that were doing opportunity zone deals. And it's funny because it's actually been the opposite, because now people are more sensitive to what the taxes are going to do. And so they're looking not to just defer the taxes, but they're like, okay, if I can put my money into something that's going to grow tax-free, I really need to be looking at that. And so opportunity zones present a way to do that. And so what's funny is that we've actually been having to figure out ways to generate capital gains for people recently, right? Like, hey, let's figure out where you think you can get some increase, some fast delta. So that way we can seed your fund with a capital gain, and then you can bring in non-capital gains money as a loan. And then you could go do your deal in the opportunity zone. And then you're going to be able to get the ultimate back end step up in basis to fair market value, not pay any taxes on it.
Yeah, I hadn't really thought about this as an alternative to a 1031 because of that pressure. So I'm assuming, and we've had Matt Linville on here a couple times talking about 1031 exchanges, and when there was looming chatter about certain things going away.
Yeah.
Right. I mean,
it's like,
and we had one of Jack's colleagues on. That was interesting. Fortunately, it was much ado about nothing, but
yeah. One of the other things that people really need to pay attention to inside of the 1031 is that if you are approaching $10 million of net worth and you've got a crap ton of money that you've just been rolling over in 1031s, it's just, people don't talk about this. And it's really wild to me, but they're like, hey, you're going to get a step up in basis at fair market value at death. Right. And that's the problem, is that you get a step up in basis to fair market value at death. And so your estate has to pay taxes on that within 180 days of your death at fair market value. And so if you're underneath the lifetime exemption, and that's the reason why people aren't talking about it, is because that exemption has been so high. It's $11.7 million per individual right now. So 23.4 for a couple. But if you're that's going to drop down to $10 million as of December 31st, 2026. And so if you're at around 10 million bucks or over, then your estate's writing a check in 180 days. And that's, I mean, people are really not talking about that. And that's the big differentiator inside of opportunity zones, is that they're kind of I call them a poor man's irrevocable trust, because the amount that it goes against your lifetime exemption is the amount that you contribute into your QOF, not what it's grown to as of the time of your death. And so your estate steps into your shoes as the taxpayer. And so if it's before 2026, they're going to have to pay the back taxes that you deferred. If it's after 2026, they're basically just going to have the amount that you put into the fund to pay to go against your $10 million lifetime exemption. And so that becomes really powerful. Another really powerful tool that not a whole lot of people have paid attention to in the opportunity zone world, but to, your savvy people, if they're on this webinar, they're fairly savvy relative to, real estate and taxes and that kind of thing. And that's a big differentiator.
So our gallery is somewhat quiet today. I'm surprised. The only way we knew Papa Joe was on is by him
dropping into the Q&A. We don't see any in the Q&A or in the chat.
Turn on the thing,
Maybe they just don't like me, right?
No, that's not true. You do hit rapid fire, which is good. But here's what I would say to anybody on this call: make it really simple. No question is stupid. So
sure.
The only stupid question is the one that's not asked.
I tell you what, so while we're waiting on that, I'm just going to go ahead and, like we already pulled out the fire hose. Let's crank it up.
Hold on.
Let's just go ahead and just douse everybody real fast, right? At the very least, it'll show people kind of generally the mechanics of it. But I regularly use this. I'm a hardcore visual learner. And it's funny, is it's going to be a little bit hard to read on that one. Maybe a little bit easier to read on this one. And
yeah, better.
If anybody wants this, they can go to ozpros.com/cheat sheet, and you can download this form for free. And this is effectively opportunity zones on a page, right? And so, and there's a lot of information on here, but I want to show how simple it is. So you got to have a capital gain from a sale to an unrelated party. So you can't take your hand turkey that you made in kindergarten and sell it to your mom for $1 million and use that as your capital gain. It's got to be an unrelated party. But you get that capital gain into your qualified opportunity fund within 180 days. And you've now deferred the taxes till December 31st, 2026 or December 31st, 2028, if the legislation goes through. So once your money is in a fund, once again, can be an LLC taxed as a partnership. So that's what we do regularly is we set up an LLC that's taxed as a partnership. We get the EIN, and then people go get their bank account and they drop their money in, and then that literally stops the clock. Bam, right? Now, once your money is into the fund, you can either invest it directly into qualified opportunity zone business property, or you can invest into qualified opportunity zone property through what we call a qualified opportunity zone business. And so because of that little, and I don't want to call it a loophole, but they created this kind of double stack structure. What that allows us to do is to move the money into the QOZB, and we can meet our 90% asset requirement at the QOF level. So the QOF has to have, 90% of its assets in opportunity zone property tested as of twice annually. So we dropped our money. Let's say we put $1 million into the QOF. Now we need to take 900,000 of it and drop it into the QOZB effectively by the end of the year or by June 30th of the following year. It's between 6 months and a year. Okay. And so this other $100,000 that we've got up here, we can put that money into whatever we want. We could put it into cryptocurrency. We could put it into Tesla stock. We could put it into whatever you think is going to appreciate the most in value. And you're going to get the same benefit for that money as you would for any of your other assets, which is after a 10-year hold, you're going to get a step up in basis to fair market value. So once your money is into the QOZB, we've got some tests down here, right, that apply to that qualified opportunity zone business. And including the 70% of your tangible property needs to be qualified opportunity zone business property. And that definition is right here, which means that it's acquired after December 31st, 2017 by purchase from an unrelated seller, or you can lease it, right? So you could have an operating business. So if somebody wanted to start up the next Facebook, they could literally go lease a space in an opportunity zone, and that's going to qualify for this test. And then they could grow that thing over the next 10 years, and all of it's going to come out to them capital gains free. And then if you actually are doing real property, right, and you're not leasing it, the original use or substantial improvement needs to happen in an opportunity zone. And this is where I think that if anybody's out there listening, they've heard of this concept of doubling down. So if you're going to substantially improve a property that's in the opportunity zone, you have to double the basis of the value of the building. So if this was $1 million purchase of this piece of property and the building's worth $550,000, you're going to have to put another $550,001 into it. And so you could do that in a number of ways. You could, if you had contiguous property, you could build on the contiguous property. You could add square footage. You could put solar on the roof. You could add an accessory dwelling unit. Or if it's like an Airbnb, you could furnish it, and the furnishings are going to count towards that substantial improvement requirement. But that's opportunity zones kind of in a nutshell, really fast. Right. It's like, all right, let's just go ahead and douse everybody with that fire hose. Jack's over there like, holy crap. He's like, I'm a lawyer, and that was freaking crazy for me.
That was awesome. No, I really appreciate that. And that I'm still astounded at the comment about the 1031 running out, the clock's running out, and you can do something with it, because that actually has happened twice this year, and we've concluded the transaction, but it was a nightmare because no one came up with that. So now, and I think, if you have an article on that, if you don't, you should.
Yeah, I need to write a white paper on the comparison between 1031 and 1400Z. Now, unfortunately, you can't do both, right? So when you elect a portion of the gain, right? So if you've got money that's going into a 1031, you can't then combine that with 1400Z. But in the context of an aggregate gain, let's say that they had $1 million of gain and they identified successfully 500,000, but then they were going to have 500,000 of boot. We can take that 500,000 of boot and drop it into a fund. And so
we got a couple of questions that have come in. So there you go. Papa Joe jumped on it first, so we'll hit that. Are you suggesting for an S corp owner that when the distribution occurs, that could be used for that could use this for the tax avoidance?
Papa Joe, I wish, man. I wish that we could do that. But unfortunately, an S Corp distribution is not considered capital gain. It's considered ordinary income. And so that's not going to work. But any other capital, the other thing that doesn't work is 1245 depreciation recapture. And so if you're not able to grab that piece and defer it, which stinks, but any other capital gain, we can absolutely defer it. Now, you could set up your S Corp as a qualified opportunity zone business. Now, it's a little bit more complicated because we have to make your QOF an S Corp as well. And then your QOZB would be a Q sub, a qualified subsidiary of that S Corp. But when we do that, we can now make it so that you can get all the benefits of an S Corp. And then when you go to exit that S Corp on the back end of your 10-year hold, you pay zero capital gains taxes on it. And so we've done that a lot, where we've moved people from outside of the zone into the zone, and we're effectively able to get them a tax eliminated exit on the back end. Now, it's not going to affect your income along the way. So your income, you just pay income taxes on it like you would normally would. And then you use your depreciation and your cost segregation study and that kind of thing to offset that income. But on the back end, we can make it so that the tax goes away.
Very cool. Brett hits us with this question to take a drop from the fire hose. On an inherited IRA, can any distribution be rolled over into another tax deferred account?
So, and you guys are going to have to help me out with this one. Is an inherited IRA, when you take a distribution from that, is that considered a capital gain event?
We need Adam.
Yeah. So, and I think that it is. I think that you pay. So if you wouldn't take early distribution, you wouldn't have to pay penalties on it. But to the extent that it generates a capital gain because you're pulling it out, which I think that it would, right? You can roll that portion of it over into a qualified fund. Absolutely. So the key piece on this, right, is that the capital gain needs to be reported on your 8949. And so as long as it's going to get reported on your 8949, and so, you know, your 8949 is where you, that's where you report sales and dispositions of capital assets, whether it's short-term or long-term. And so if it's going to appear on here, Brett, then yes, you absolutely can roll it into an opportunity fund and you can defer it that way.
So here's what I'm going to do, Brett, because we like you and I love your creativity on the front end of this question. I'm going to send this to Adam and he will answer it, and then we can get back with you on that. And I think we'll have your email address based on your registration, so we can do that. Ashley, as we're kind of rounding home, we've got a few more minutes. If somebody wants to reach out to you, what's the best way for them to do that?
So we've got a special, so what we've done at OZ Pros is tried to democratize access to opportunity zones. And, we've done it through education, through setting up a number of funds, a lot of funds, and then also through an ongoing compliance situation. But as a result, like we've got a fairly regimented process for how folks interact with us, because we've got people from around the country that are regularly, trying to get information about this. And so we've got a strategy call process. And so if you go to ozpros.com/podcast, so I set up a special link for you, Gary, for this podcast. If you go to ozpros.com/podcast, you can get a discounted strategy call there. You can also get our cheat sheet. You can find the map where you can look up if you want to find if an address is in an opportunity zone. And it also has a link to our compliance boot camp, which is a weekly call, very similar to this, but where we do rapid fire kind of Q&A and that kind of thing. And so that's available at ozpros.com/podcast. If you want this, if you want my slide deck, if you shoot me an email at ashley@ozpros.com, I can get you our full slide deck, which has got all kinds of, deep information on it. And then we've also got a webinar that's a kind of an introductory webinar that goes through this maybe a little bit slower than it basically just expands what I did with the cheat sheet into about a 30-minute process. And I'm almost positive that the webinar is on that same landing page, but if not, email us and we can send you a link to the webinar as well.
Yeah, that's good. So I put that in the chat. So ozpros.com/podcast, as well as your email address. Did I get that right?
That's right.
All right, cool. As we're rounding the base to home, any
We could
questions?
see the clubhouse.
That's right. Well, there you go. Towards the 18th hole then. Anybody have any questions that are related to this or something that Jack can answer? Not Adam.
Jack's got his hand up. I love it.
Yes, both electronically and in reality. So my question, so here's a scenario is that I have money to invest. I've heard about opportunity zones, but I have no expertise in construction or architecture or anything. And so, but I'm thinking I may want to do it on my own. So what are the logistics of either doing it on my own or maybe explaining that, an opportunity zone fund operator, manager, it has all that stuff. I mean, basically it's an investment. So they are the ones that, kind of come in and do so maybe discussing kind of behind the scenes, what really goes on in, the use of my money in with respect to the development of the actual project.
So, once again, right, like if you're going to go and you're going to be a passive investor into an LP, then you're going to want to really look at the strength of the sponsor and their experience, right? And then, kind of what their investment thesis is and make sure that that aligns with your overall investment objectives. And then look at what their plan is for how they're going to be executing that. So that's if you're making a passive investment. So we deal with a lot of people that are just like what you just described, that are like, hey, I don't really have any experience in doing real estate development or anything like that. And the cool thing about opportunity zones is that you don't necessarily have to. And so we've set up funds for people, and then we've plugged them in with people that are constructing stuff in opportunity zones. And as long as you buy it before it's been put in service, so that's before it's been depreciated, before it's been rented out, or before it's been made available for rent, and ideally you're as close to the certificate of occupancy as possible, then you can get original use classification for that. And you could literally just have your money go into that. And then you could hire a professional manager to manage the tenants in it or to manage, right? So we've got shopping centers that people are selling as original use. We've got condos, townhomes, there's a litany of people out there across the United States that have figured out the opportunity zone play, and, that they can build something and then they can sell it to an opportunity zone investor. And because you've got some tax deferral in there, they can maybe get a little bit more from an opportunity zone investor than they could if they just sold it regularly. And so that's one of the things that is really powerful. I'll round us out within that one of the best parts of the program, as it relates to flexibility, is that you can put your money into an opportunities fund and put it into a project or put it into like a newly constructed building or whatever. So you could buy it all in cash. And then in 2 years, you can refinance that and you can suck all of that cash right back out of it and put it wherever you want to. And, for us that are right plugged in, you're like, why would you want to pull cash out of a tax deferred asset and put it into a taxable asset? But it gives you the flexibility to be able to do that if that's inside of your, like, where you need to be allocating your money. And so that's the final piece that I forgot to tell everybody as I was going through my rapid fire hose. But that, so there's lots of options, Jack. And even for people that aren't necessarily aspiring developers. I mean, one of the other things is that we have people all the time that sell their business and they're like, hey, I want to do, I want to basically start another business, but not that one, because I got to non-compete and that kind of thing. So they sell their business. We help them start the new business in an opportunity zone. They hold that for 10 years. And then all of the growth of that new business is going to come out tax-free.
That is pretty cool for anybody listening live or on the recording. So we will put this up on the BGW CPA YouTube channel this afternoon. Anybody wants to go back to it. One other thing that I will add is as rapid fire as Ashley can be on audio. If you ever want to meet him in person, he can be a little bit intimidating because there you go. Can you see this? He's not standing on a stool and I'm not standing in a manhole.
That's actually really funny. You showed it to me on your phone, but then when you get on it on Zoom, it becomes very real.
So I had showed him a picture of a guy that I met last week. So Ashley and I got together last week, and this guy is also 6'8" and makes me look like Danny DeVito next to Arnold. But so Ashley's like, yeah, I'm exactly same height. So I evidently have triplets out there. I'm one of 3. So
I'm never going to stand next to you, Ashley, ever.
It's funny. Yeah. So, people ask me all the time, right? Because when you're 6'8", people are like, oh, dude, how tall are you? And they're like, oh, what's it like being that tall? And does it bother you? And I'm like, well, I never really considered myself tall because my dad is 7 foot. And so I grew up always, my dad's 7 foot and he was a 2-time All-American at Duke. And so he not only cheated me 2 All-American statuses of basketball talent, but he also cheated me 3 inches, right? And as I'm now, basically out of college, you're like, man, thank God I'm not 7 foot, because 6'8" is bad enough. My kids are now like, they're hitting their growth spurts and they're like, Dad, I don't know, man. I don't know that I'm going to get past 6'5". And I'm like, count your lucky stars if you don't, right? 6'5" is like ideal. And anyhow, so I just never thought of myself as tall.
Yeah. I never thought of myself as short until I see myself in pictures. All right. This has been a great hour. Ashley, we'll have to have you come back again because I have a feeling we'll be continuing to do these for a while. As long as we keep having people show up like Papa Joe and others that feel like, hey, we're bringing value. That's a great thing. Papa Joe did say Grubb Properties, Clay Grubb is also a fellow Tar Heel. So there you go.
Yep.
Great to have you guys back here.
Yeah. So I'd love to come back in and talk. So we've got some cool like passive investment deals. We're working with a group right now that's got a bunch of oil and gas wells in opportunity zones. And so then you couple in all of the depreciation and that kind of thing with the opportunity zone program. And so and then we got solar. And I don't know if you guys have hit and really expanded on the solar thing, but inside of the Inflation Reduction Act, they have an extra 10% that's available if you're in a low income area, and pretty much every opportunity zone qualifies for that. So if you couple in solar inside of an opportunity zone deal, you get all of that investment tax credit in addition to the deferral. So you're basically picking up ITCs with deferred dollars. I mean, it's like, holy crap, this is like the ideal. It's like a unicorn.
Wow. That's interesting.
I
Ashley,
love making Jack laugh, even on mute.
You don't hear that very often, a commercial real estate unicorn. So I'm just loving it.
Good times. Next time on the next episode, I'll have to talk about rainbows. So we can talk about rainbows and unicorns, right?
Jack will get a special background for that.
That's exactly right.
All right. So good to have you, Ashley. Good to see you again. Same way with you, Jack. And Adam's going to have some fun with this one too. So, but he'll have to watch the recording like everybody else. Enjoy the rest of your day. Enjoy next week off with your families. Happy Thanksgiving. And we'll be back in 2 weeks, Lord willing. Thank you all.
Thank you,
See
guys.
ya.
Cheers, y'all.
Bye-bye.